Hello, and welcome to Palm Springs Life Market Watch. I'm Gianna Lacosto of Palm Springs Life. Is a normal housing market right around the corner? Let's find out. Today we present industry experts Michael McDonald of Market Watch LLC, Walter Neal, CEO of Franklin Loan Center, and Kenny Cassady of Meredith Lodging. Before we begin, we'd like to thank our sponsors, Franklin Loan Center, Renova Energy, Meredith Lodging, California Desert Association of Realtors, and Greater Palm Springs Realtors. Kicking it off to Michael McDonald of Market Watch LLC.
Good morning, ladies and gentlemen. Welcome to the Market Watch May webinar. The title of today's talk is A Normal Housing Market Just Around the Corner. This is a fundamental question being asked all across the country. Is there something inherently wrong with the housing market? Why all sales numbers are down and prices seem to be retracing a little bit? Or is this all man-made, created by our Federal Reserve Board, over anxious to create a high level of inflation that was triggered a year ago? And that's the issue. We're going to answer this question and address the various components that make it up. I'm going to give it to you right up front. The housing market is in fine condition. I know the numbers aren't there, but there's nothing inherently wrong with it once the Federal Reserve gets off the economy's back. Rates are about 2.5% above where they should be, engineered by the Federal Reserve in an effort to corral inflation. Once that disappears, the market will come back to what it should be at. A lot of people are nervous about a price decline. There is no sign of that. There is absolutely no sign that this market is anything other than being perturbed or disturbed by the actions of the Fed. And even in the face of a recession, we don't have much really to worry about. Now, I normally talk about 30 to 40 minutes or so. And this today, though, I'm intentionally cutting it shorter for a reason. I don't want to overcomplicate it. I'm going to show you the current situation of the housing market as it exists right now, and the why things are down, not why, how much things are down. The why is another reason. That's going to be covered by Walt, who's going to get into the economics and the financial aspects of what's going on with the marketplace because of the Fed. I'm going to show you the results of their actions and why things are not that unstable, why we should actually expect stable home prices. So let's get into the presentation. I'm going to talk specifically, and as I always do, I'm going to give you a summary right up front of the main points of the presentation. I always do this. Know before you go. That motto drives everything. I don't want you to sit there and say, where is he going with this talk? I'm going to tell you right up front the conclusion of today's talk and then show you the evidence that led to these facts, okay? As we do in almost every May seminar, long-term valley rents, we cover the long-term rental situation. Short-term rents will be covered by Kenny Cassady, who's going to be talking after I talk, a talk on the short-term rental situation. I'm going to show you the numbers on long-term leases that exist for a year or longer, okay? And basically, long-term leases are up 35%. That doesn't mean the number of leases are up 35%, but the price per square foot, what a person pays for rent, has risen 35% over the last 2 years, and it's little changed over the last 5 months. That's very important. What is happening locally in that the rents are not going up has been happening across the country. That's important because 40% of the CPI index, the inflation index, is composed of what's called the shelter component. Shelters include primarily rent and rent equivalents. And the fact that rents have not been going up tells you that 40% of the consumer price index is going to be somewhat stable or coming down, okay? Will not be going up like it has been over the last 2 years, okay? And then homeowner fears are misplaced. Home prices should remain stable. While supply and demand are both lower, they remain balanced. That's very, very important conclusion. We have to educate our clients onto what's going on, and their fears are misplaced. There is nothing wrong with this housing market. People say, well, it's gone up 40–50%. Don't prices have to? No, they do not have to decline after rising like that. There's no sign of any price instability at all, even in the face of a recession. Sales are down 27%. When we say sales, we mean buyers. In other words, if sales are down 27%, the number of people buying homes in the region is down 27%. These are numbers for the region, not for the nation. Other areas of Southern California are actually down more. In the Valley, sales or buyers, the number of buyers in the region are down 27%. And now, why are they down? Well, one of the main reasons they're down is because of this next listing. This next point. New listings are down 30%. In other words, the number of sellers of homes, because most buyers are people who sell and rebuy somewhere else. If sellers, the number of sellers are down, you're not going to find the number of buyers going up. They're just not there, because if they don't sell, they don't buy. So they're down also 30%. Now, that's the interesting situation. Sales and new listings are both down. Supply and demand, you only get into pricing problems if there is an imbalance of supply and demand. If demand goes down, but supply goes down equal amounts, the two forces stay in balance and prices will be stable. That's what we have going on right now. Inventory is 50% below historic norms, but the numbers are stable. I'll show you the chart of this as we get into it. High mortgage rates are freezing the market. That's the problem. The Federal Reserve Board, in their effort to restrain inflation for the entire economy, is creating collateral damage in other markets with these higher abnormal rates. It's hurting not only the housing market, it's keeping people from listings, from selling their home. It's also hurting the mortgage industry, and it's hurting the banking industry. A lot of banks are suffering because of the higher rates too. So there's a lot of collateral damage going on. We don't think that's going to trigger something severe, but it is a little bit of a worry. It doesn't seem like it's going to affect the housing market, though, very much here. The housing market will return to normal. Remember, the question is, when will we return to normal? Once effective mortgage rates return to 5% or less. I say once they get to effectively 4.9%, that's the magic bullet in the magic number in my mind. Walt thinks it's 5.5. Most people say 5.5. I say 4.9. That's a trigger. The difference between 5.5 and 4.9 is not much, but it's a big psychological number. So, okay, let's get into the first thing we're going to cover are rents. This is a view of long-term rents in the Coachella Valley. These are 1 year or longer. They're up 35%. Now, what are these two curves here? This goes back to 2011. The dark number is the price or the rent per square foot of a detached home. Going back 2012, 2013, it was actually 2014 here. It was about $1 per square foot. With a 2,000 square foot home, would rent for about $2,000 a month. Now it's almost up to $2 a square foot. So rent, especially in the last 2 years, rents have dramatically gone up. Now notice they're flat. Okay. Now notice a couple things. Condominiums rent per square foot more than detached homes. So I wanted to point this out. The fact that it's flattening out is important for reasons we just described earlier. Now, we've also got these numbers. I'm not going to go over them here in any kind of great detail, but your PDF, you'll actually have a hard copy of this. This is very beneficial to keep on your desk, because you might have a person who wants to buy a home to lease it out. And he might say, if I buy a home in Tuscany or in Four Seasons, what can I rent it for? Well, you've got this table here that'll show you this. Over here on the left side are all the various subdivisions, the average size home in each one of the subdivisions, the rental price, the long-term lease price per square foot, and the if you multiply these two numbers, that's the monthly rental per monthly average for that average home size. Okay, we have over here attached homes and detached here. So we have 2 pages of that. So you have this as a reference. Now let's get under the housing market itself. Home prices should remain stable. Supply and demand are both down, but remain balanced. That's the key. Now, what are we looking at here? This is the median price of a home in the Coachella Valley, a detached home, And this is what people are worried about, that this big price rise back in 2005 was followed by a collapse, which was that terrible period in 2009, 10, and 11 with the foreclosures, et cetera. People are worried that this is going to be a prelude to another crash. It is not. There is absolutely no similarity between these two. Absolutely none. Matter of fact, you have the exact opposite. Here we had very unstable market. You had 60 to 70% of the loans outstanding were variable rate mortgages that had a reset problem when rates went back up, and they did. They had to reset, and people couldn't make their mortgage payment. Back then, the amount of equity was very, very low in homes. You have the complete reversal of that here. The mortgage market is highly stable, and the amount of equity in these homes is huge compared to what it was. There's absolutely no relationship here between these two. So and I can go item to item to show you that. I won't do that, but they're all there. There's no correlation here. You can actually see people thought this might be the beginning of a decline here late last year and the beginning of this, but we're already now not too far away from the highs of last year even. So it looks like we're in what's called a tight price band here. We don't expect much of any further price decline than we have here. Now, inventory, this is Valley inventory going back to 2018, May 1st. We always show May 1st values here because it's seasonal. And we have the latest value on May 1st was 1,876 units. Of course, it fell very, very low here down to under 1,000. But we were disappointed. We expected inventory to rise back up here to 2,500 to maybe possibly 3,000 with this surge, but it didn't. It didn't go up for a very simple reason. Even though sales are down, we weren't getting number of new listings to refill that inventory. So it hasn't come back. So inventory is light. Another reason that you're going to have price stability. So now I want to show you these in greater detail by city and to show you some actual numbers. This is graph. I like graphs. Some people don't like graphs. I like graphs. To me, they tell me everything. You can see where we are compared to the past. You can kind of draw a line over here and say, this is what it used to be. Here's where we're at now. So you can visually see the situation. Some people like tables, so we'll show you the table. So this is a picture of inventory, okay, as running 50% below average. Now, what is this? This shows you the April average of inventory. Again, because of seasonality, we'll always compare the same time of year. And since actually, this should be May 1st. It should be the end of April, May 1st. These are the numbers, so this is incorrect. These should be May 1st. Normally, the average between 2017, 18, and 19, the May 1st number was 4,000 units. We're all in inventory. This last May 1st, it was 1938. We're down 51.6%, over 50% decline. We have each one of the cities. Some cities have a larger decline in inventory. Desert Hot Springs is down 32%. We have them ranked by the size of the decline. Some of the cities, for example, La Quina, inventory is off 64% below the pre-pandemic average. Indian Wells is almost three quarters. So almost 75% below the pre-pandemic average inventory that it had in 2017, 18, and 19. So we have this here. Now let's take a look at the buyers. What are buyers? We already know buyers are down 27%. Where did we get those numbers? And we got it from right here. Now this is the Coachella Valley. The monthly average, this monthly average is the monthly average of sales between January, February, March, and April for the 4 months of the previous 6 years, 2013 to 2019. On average, in the Valley, we had sales of 780 units a month. 543 were detached, 237 were attached. This year, for the first 4 months, were 391 detached, 176 attached for 467. Here is the 27% decline. Notice that detached homes are 28, attached 26. So the home type, it's about the same. So it's really independent of the home type. A little bit more detached, but not much, okay? Now let's take a look at these numbers by city. Here it is by city. Indian Wells, we have, for example, Indian Wells, the average between 2013 and 19, we had 25 units sold per month in those first 4 months of the year. This in 2023, we had 22. So we're only about 12% below the average, all the way down to Cathedral City here, which is, excuse me, let me move this here, 38%. Okay. This shows you the numbers by city. Now, these are the number of buyers. How about the number of sellers? Now, this is the interesting one, the one that you seldom see. We have 30% fewer sellers. This is the monthly average for the whole Coachella Valley of the number of new listings per month in the first 4 months of every year. Between 2013 to 2019, we averaged 1,360 new listings a month in the first 4 months of the years before the pandemic. This year, it's 949. So we're off 30%. The number of new listings are off 30%, 31% for detached homes, 28% for attached. By city, we notice Coachella, for example, we normally have 21 new listings a month. Before the pandemic, it's now 18. We're only off 14%. Palm Springs, normally 273 new listings a month. In the first 4 months of the year during the pre-pandemic period, we're now at 212. Not bad, down only 22%, all the way down. So we show you the numbers here for each one of the cities, okay? So that is the key. So want to summarize here the key points. I told you it would be simple, but I don't want to complicate it. Those are the key numbers. It shows you what's down, and I'm going to explain why it's down. Increasing the number of new sellers. That's the problem. We need to get new listings up. Get new listings up, buyers increase. So inventory will increase, the number of new listings will increase, and the number of buyers. Sales will come back to normal. We need to get the number of new listings up, okay? More sellers will increase the number of rebuyers and return the market to normal by raising both sales and inventory. How do we get more people to list their home? Okay, sellers will come out once effective mortgage rates reach 5% or less. I say 4.9%. As I mentioned before, home builders, by the way, are finding this out. This is the reason. Okay, when they raised, when they sell their inventory at 4.9%, they're buying their mortgages down and offering people to buy the new homes at 4.9%. They're getting a ton of people who want to sell their existing home and rebuy and get a new home at 4.9%. So they've increased their sales 20 to 30%. We would get the same thing here. If we could offer them rates here at 4.9%, you would find sales would spring right back to normal. There's nothing inherently wrong with this market. Everything is kind of back, should get back to normal as soon as the Federal Reserve Board comes back to normal. The largest sales increase will be in residential markets. And that's it, ladies and gentlemen. That's the summary of the situation as it exists. Now we're going to have Kenny Cassady, okay, of, let's see here, Kenny Cassady of Meredith Lodging, okay? He's a specialist in short-term rentals, and he's going to talk here about the short-term rental market, and that which will be followed then by Walt, who's going to get into the financial aspects of the situation and what's going to happen from the financial, when the Fed's going to probably drop rates again and bring this market back to normal. So listen, thank you again. It's good to see you again. And hopefully you can tell one of the live presentations, we miss seeing you actually in person. So try to make the live presentation so we can see you again. Thank you very much.
Thanks, Mike. As Mike said, I'm Kenny Cassady with Meredith Lodging. And what Mike was covering earlier in his presentation was long-term rental, otherwise known as annual leasing. What I'm going to be covering for you is short-term rentals today. And first, let me put that into perspective for you as far as what we're going to cover. What is a short-term rental? A lot of people don't even know exactly how to define short-term rental. So I'll do that for you. We'll also talk about where we can do short-term rentals here in the Coachella Valley, because that's a kind of a complicated answer to that easy question. I'll also cover advice for buyers And then lastly, what can a short-term rental manager do for you? So let's get into it. What is a short-term rental? Mike was talking earlier about LTR or long-term, some people call it annual leasing. Short-term rentals, some people call them STRs or VRs for vacation rental, or short-term vacation rental, STVRs. They're all basically the same thing, meaning that it's rentals of less than 28 nights. We do rent nights in our industry, just like hotels do, not days. So we always try and define it in terms of nights. So less than 28 nights is a short-term rental. That's something that's regulated by the city or the county. And we charge transient occupancy tax, just like hotels do. And then there's usually a whole raft of regulations that come along with that. Monthly or seasonal rentals, those that are 28 nights or more, are unregulated. We don't have to permit those with the city or with the county. And some people call them 30-day rentals or monthly rentals. It can get kind of into the weeds when you try and describe the difference between how a city defines short-term rentals versus how an HOA might define short-term rentals. But generally, I try and just use the word monthly, because a month is a month, no matter how you slice it or which month it is. I think maybe they came up with the number of 28 simply because of the month of February. If there's 28 nights in February, you rent the entire month of February. Now that's a monthly rental. So it's one way to remember it. And then, of course, LTR or long-term or annual leasing is typically 6 months or more. It's typically unfurnished, and that's a completely different topic. So just like some people say, math is hard. I say it all the time. Regulations are hard. Here's just a visual for you of how hard they are, how complicated it is just here in the Coachella Valley. I tried to break it out in a colors chart here, but even then it's a little confusing. So those that I like to describe as smartly regulated cities, the cities that have created rules and regulations and enforcement mechanisms to make sure that those rules are followed, those are the cities like Palm Springs, Desert Hot Springs, Indio. I would put Bermuda Dunes in that category, even though that's unincorporated Riverside County, but right now they're still under smart regulations. Those that are frozen for now, maybe mostly because of moratoriums that are in place, would be La Quinta. Temecula and Idlewild are unincorporated Riverside County areas, but the county has imposed a moratorium on new permits in those areas. So same thing with La Quinta. They're doing short-term rentals, but no new permits are being issued until they sort out the rules and regulations a little further. Then the third category is banned short-term rentals. Cities like Cathedral City, Palm Desert, Indian Wells, they do each allow them specifically only in HOAs that allow short-term rentals, but outside of that, for the most part, except for some very specific zoning areas, see how confusing it is. They're basically banned in those cities in residential neighborhoods. Then completely banned in that category currently would be Rancho Mirage, as a city that doesn't allow them anywhere in the city, even in HOAs that previously would have allowed them. They don't allow them there anymore either. So that just gives you a visual of what how the valley is kind of sliced up on regulations and where we're allowed to do them. We're sort of bookended at both ends of the valley, with smartly regulated areas being on the left and the right there on the map. So why is this important to us here in the valley and to you as realtors? Really, that's because we have a lot of remote owners here in the Valley. Nationally, the National Association of Realtors says that more than 50% of people who buy a second or vacation home intend to rent that home at some point in time. Now, we know that's probably higher here in a resort market like this. That number is just a national number across the board. Here in the Coachella Valley, more than 50% of our homeowners are remote or second home owners. That number is a little lower for single family residences and a bit higher for condos, but it sort of averages out to a little bit more than 50% across the board. Therefore, just slicing this pie up with the math, like I said, math is hard, but in this case, it's pretty obvious. Therefore, at least 25% of our buyers and homeowners are intending to rent that property out in some way or form while they own it. So if that's the case, then I think it behooves us to have some data and some projections on hand for those folks who are thinking about renting the property out after they buy it. If it's 1/4 or more of our buyers that are thinking about that in their head. So what can we do for them? The most frequent comment I get from buyers who are just starting the research process, maybe they're working with a realtor already, and they say to me, I just want to cover my expenses with rental income. I often find myself saying, don't kill the messenger, but, and then I continue with, that's really difficult to do here. We are a seasonal market. We have a lot of rental restrictions. California real estate prices, the price to purchase something here is generally much higher than the rest of the country. So if you're trying under all those conditions to cover a typical 80% mortgage, that's a really big number to cover. It's not likely to happen. So I always try and direct them on where are the financial benefits that are outside of the pure dollars coming in every month that are hopefully covering a good part of your expenses. So here's how I do it. Short-term rental income is a great way to offset the cost of ownership. You're going to make some money to help you pay for this second home or this vacation home, but don't expect it to cover all your expenses and be a cash positive venture. It's also for those who are wanting to come and spend time here in the desert, it's also a great benefit and certainly has some value to it that you can come and enjoy the property yourself versus an annual leasing kind of rental situation where somebody moves in there full time and that's not an option for you. Your expenses may also be tax deductible to some extent. I always advise consult with your tax advisor. I'm not a tax advisor, but let them help you sort that out and see how much of your expenses and which ones in particular might be tax deductible. Lastly, the market, as we all know in this room, the market will hopefully give you equity while you own the property, right? So there's another revenue upside in the long run, if you will, that you're going to build some equity while you own the property. Whenever and I've done a blog about this before on palmspringslife.com in the past, but whenever anybody starts talking about, I'm thinking about buying and I'm thinking about maybe renting, I always give them these three pieces of advice. And that is, one, work with a local realtor. I know that's going to be real popular with everybody watching this today, but work with a local realtor, somebody who understands the local market, like a realtor from out of town just can't quite grasp the details of how, like that map that I referred to earlier, how that's sliced and diced. Many of us that live here full time have a struggle understanding that map. So work with a local realtor. Find a good mortgage broker, a lender who can pre-approve you and have you ready to make offers when you do find a good candidate property and you need to move quickly in order to take advantage of the situation. Lastly, round out your team of consultants here by consulting with an experienced short-term rental manager, somebody who can provide guidance to the best rental results. You can ask them lots of questions on ways to help you achieve your financial goals and still provide you with a property that is something that you're interested in owning and spending time at yourself. They can help you do that. So to sort of put it in a nutshell, what a professional short-term rental manager does, because a lot of people don't necessarily know that either. A full service manager is somebody who acts as the go-between between you and your guests. A homeowner will have no contact with the guests whatsoever. The full service manager handles everything, all the guest interactions, bookings, cleanings, coordination, maintenance, everything. Also, very, very important, a full service manager will be in charge of compliance. They're going to make sure that we're following all local and state laws around rentals. And very importantly, for those municipalities that are imposing those rules upon us, one of the biggest reasons they do it is to collect transient occupancy tax. So we collect, remit, and report on the transient occupancy tax, or the TOT, every year, and then we generate tax documents at the end of the year so that homeowners can consult with that tax advisor and move forward with their taxes each year. Also very important is enforcement. The rules are no good unless they're actually being enforced, right? So we're making sure that the rules are being enforced as they should be, and that we're here for immediate response. If there's any kind of an issue with guests or the property, we're here to handle it. A really good short-term rental manager, an experienced manager, will also be there to provide, like I alluded to earlier, some guidance to homeowners and buyers as they look into this and consider their options. It's really important to have conversation on how to reach their goals. I can't tell you how many times I've had that hour-long conversation with a buyer or prospective buyer or a homeowner, and they're very grateful for the information at the end of the call, and they feel so much better enabled to go out there and achieve their goals afterwards. And I enjoy the conversation too. It's actually a lot of fun because they're really excited about their new purchase and what they're going to do going forward. Something we also offer as short-term rental managers in this industry is specific property rental projections. We want to be able to help them when they identify a property as a candidate purchase. I'm thinking about making an offer on this one, or maybe these two properties. How much might I make on these two properties as a short-term rental? I'm very careful to never say you should buy this house versus buy that house or that condo. I give them the facts and the data and let them decide. I always say that's between you and your realtor for you to decide what to do. But here's the data from a short-term rental perspective, and you go forward and good luck. And I will be here to help you achieve those goals afterwards. And I'm rather conservative, like any good manager should be, with those projections, because we want to make sure and give them achievable numbers, right? And realistic expectations. So another thing that we do provide as short-term rental managers, I know I do this, is realtor referrals. So anytime a realtor comes to us with an introduction to their buyer, we're going to, if we get that buyer and their property ultimate purchase signed up into our portfolio, we're going to come back and offer a referral fee to that realtor for the introduction and thank them. And then lastly, for realtors who have your own listings, we like to do pro formas for those listings. It's an actual document that you can share that has a projection on it. You can share it with prospective buyers that has a projection on it that tells them what this property might make as a short-term rental. Because as they look at different properties and they consider their options, having that question, at least 25% of them have that question in their head, as we discussed earlier, then having some knowledge and numbers in front of them to help them make the decision will certainly move things along. The idea being, we want to help you get it sold faster, and maybe even at a higher price, because the buyer can now attach some revenue to their equations and figure out what's going to be the best option for them. So that's kind of the overview of what a short-term rental manager does. I know that was fast and furious with lots and lots of information, and I'm happy to answer any questions going forward and help arm you with everything that you need to know to guide your buyers appropriately, just like any short-term rental manager would be. One of the biggest questions that's always on buyers' minds, of course, as they get into these transactions is, how am I going to pay for it all? I mentioned finding a good lender earlier that can help pre-approve you and guide you through the lending process. And that's a perfect opportunity to introduce you to our friends at Franklin Loan Center. I believe we have Walter Neal is going to be presenting next on where we are in the loan world and in the money world. And I will toss it now over to you, Walt.
Good morning, Market Watch family, and welcome to the May 16th Market Watch event. My name is Walter Neal. I'm President and CEO of Franklin Loan Center. We were founded in 1989, and we are celebrating our 34th year in business, which would not be attainable without the support of all of you, specifically the Coachella Valley. So on behalf of everyone who makes up the Franklin Loan Center family, I hope you enjoy this presentation. We've been part of Market Watch now for 8 years. I think these events are well respected, and we do our best to make sure we're hitting on topics that are current and information that you can use to benefit your businesses and help your clients and friends and family. So on that note, we'll jump right into it here. So here is a review of what I'm going to be talking about today. First of all, it's inflation. I'm calling this the new COVID because when we had a war on COVID, it was a global war, and we did everything from shutting down schools to shutting down businesses, making people go through medical procedures. It's something we had to do, and basically it was all hands on deck, and it's the only thing we were focused on. Well, I kind of feel like right now the war on inflation is very similar to the new COVID because that's all the Fed cares about. The Fed is worried about one thing and one thing only, and that is defeating inflation. So I'm going to talk a lot about inflation today. I think it's very important to understand what the Fed is doing, what inflation is doing, how both those things are going to impact not only your business, but the overall economy. Second thing I'm going to talk about is interest rates and the Fed. Once again, in reaction to inflation, what's happening with interest rates and what the Fed is doing. I always like to talk about recession indicators because I think it's very important to know where we are going, not just where we are. So I will talk about a couple of recession indicators and where I think recessions are going to happen and how long they're going to be. I'm going to give you an update on real estate appreciation. Everyone wants to know if real estates continue to appreciate. Do we have a bubble? So we'll be talking about that. I'll be giving you an update on inventory perspective. I know everyone's got strong opinions there. We'll also give you an update on FHFA, which is the governing body of Fannie Mae and Freddie Mac. I'm going to call it FHFA moving forward in this presentation, but they are basically in control of managing Fannie Mae and Freddie Mac, which is the government's arm to helping home ownership. And the last thing I'm going to talk about is the banking crisis explained. There's lots of concerns and worries about the banking system out there, what has happened. So I'm going to talk a little bit about that. So hope you guys enjoy the presentation. I will dive right into it. So the first thing I want to talk about here is the Consumer Price Index. This is a overall representation of the price of goods, which the price of goods are going up or they're going down. And so this chart specifically shows you two things. It shows you the blue. The blue is a headline CPI. That is the base CPI. And then it gives you the green line, which is I call the core CPI. And the core CPI strips out food and energy when it gives you that number. Now, I used to think that was really silly because obviously all consumers, you and I, we have to worry about the price of food. We have to worry about the price of energy. But the Federal Reserve isn't concerned about so much the price of food and energy based on their monetary policy, because if they were to be increasing the Fed funds rate or lowering it, that doesn't have an impact on the weather. It doesn't have an impact on foreign governments like OPEC and how much oil they're going to release. So they don't see that their decisions are going to impact food or energy. So they're really focused on what's called the core CPI, which is the green line here. And once again, the blue is the headline. And you can look at the chart and you can see that inflation peaked last year for 42-year high. So inflation last year in June peaked at 42-year high, which is every time you're saying a 42-year record, that's something that's going to catch your eye. So you can see on the left side here, this is the percentage. And you can see over here, this is the time period. Anytime on any of my slides, you see these gray areas, that's recessionary times. So it's always great to see how things impact recessions that are going on in the market. So I want to dive more into the last 10 years for you here. So this is same as that chart, the blue line and the green line, blue line being headline and the green line being a core strips out food and energy. The headline CPA as of May was 4.9%. And the core was 5.5%. So you can see that being respected over here. What's the Fed's target? The Fed is targeted to get to 2%. So you can look back here. We were really close to being right pegged at this 2% mark all the way up to about 2020. And you can see the dramatic increase we've had. The good news here is, though, you can see that the core and the headline have both come down significantly. And so we're moving in the right direction. I actually see the inflation numbers coming down dramatically over the next 2 months. I'll get into that. But this is something I just wanted you all to understand what is the cause of the current environment, and that is heavy inflation that's causing everything from low inventory to high interest rates. So I'm going to get into that. So here's a chart on the CPI index and it shows you the direction of inflation, which is obviously moved up dramatically on this chart, but it's starting to come down. So another thing we have to look at is shelter costs. Shelter costs is equivalent to rents, and it's actually home ownership. Okay. And it makes up 43% of CPI. So when I showed you those last two charts, the largest number in those charts is shelter. And once again, shelter doesn't always mean owning a home. It could also mean the price of rents. So I have two lines on this. I have a blue line, and this blue line is the average year-over-year change in rents. Okay. Now I know Mike McDonald previously, by the way, Mike, tremendous job on your presentation, as well as you, Kenny. Both great, valuable information. I know that Mike had mentioned that rents specifically in the Coachella Valley and about 70% of the cities are still going up. About 30% were going down. That is in the Coachella Valley. Okay, so I'm looking at nationally, and nationally rents are coming down dramatically. So you can see that rents almost topped out at 20%, which means they were going up 20% year over year. And now it's down, only going about 2.6% year over year. So rents are definitely declining. Maybe not in the Coachella Valley as much, but definitely globally. So that goes into the CPI index. Okay. What also goes into CPI is shelter owning homes. You can see that it's still on the way up. It's 8.2% up, which means over the last year, the cost of buying a home is about 8.2% higher. Okay. If it was at zero, then it would have been flat. And so the reason why I bring this up is the 43% number. It's like if you take a test and 43% of the test is one topic, you want to get that topic right. Well, we want to make sure you guys understand how important the 43% number is and how it's actually being calculated. So it is a lagging index, the shelter index, because it goes back over 12 months and it averages it. So I want to show you this next chart to explain this a little bit more clearly for you. And I want to apologize because the chart itself is correct. You can see the direction, the trajectory of this chart is correct. And this is a 14-month chart. It goes back to March of 2022 to April of 2023. But the numbers on here are inaccurate. So I apologize. I added this slide late and I did not catch that. Okay. So it says 0.50 across the board. It's actually not, because you can see like in April, if you take over here and you go across, it's actually 4.3. But the point here is, this is a 12-month lagging index, the shelter index, that goes into the 43%. And as it comes down, it drops out the last of these 3 months right here. February, March, April 2023 would replace March, April, and May of 2022. And you can see they were on the rise and they were higher numbers. And you can see February, March, April 2023, they were on the way down to lower numbers. And so what we're seeing here is we're seeing that 43% shelter that's in the CPI coming down. Now, I don't want you to be misunderstood that because you see this big drop in the shelter numbers going into CPI, that real estate values are negative. Real estate values cannot go up 10% or 20% a year. We cannot sustain that type of growth. We can sustain a cooler growth. So it come down at 5% a year and you own a home, you're still making 5% a year. So this is not saying that real estate values are going down. It just means that real estate appreciation is cooling off. So I want to make sure everyone understands that. And to give you a better analogy, I've used this analogy in previous Market Watch presentations. This is a roller coaster. And this is shelter costs are lagging. We talked about it over a 12-month period. I just gave you a 14-month look back. And this is really where shelter costs are. They're coming down, which means they're not at 20% year over year. They're not at 15%. They're not at 10%. They're at 8%. And that's down off the previous year. But this right here, the back of the roller coaster, for those who've ever sat in the back of the roller coaster, you see the front's already going down and you're still going up. This is the number that's actually being used, is that 43% factor in the CPI index. And so I'm confident that inflation is going to be coming down in the CPI, because this biggest reading of 43%, the back of this roller coaster is about to be here in the next 2 months. And it's going to be showing the whole roller coaster going down, which means real estate appreciation will be cooling off, not going negative. So if you own a home, I'm not saying your real estate values are going to go down. It just means it's not going to appreciate at the levels it has been basically over the last 10 years. So hopefully that's helpful to explain CPI, what it is, what the biggest factor in CPI is, which is the shelter cost, and what's going on with rents and real estate values. Okay, Fed funds rate. Everyone knows the Federal Reserve has a couple mandates from Congress, okay? And one of them is to keep pricing stable, okay? And inflation is causing prices not to be stable. So what does the Fed do? Well, first of all, the Fed has what's called the Fed funds rate. They control the cost of that. And that's what banks borrow from each other. The current Fed funds rate, FFR's Fed funds rate, is 5 to 5.25, and that was just increased a quarter in May last week. The next meeting is going to be June 13th to 14th. Right now, it's most likely they will not be making another move on the Fed funds rate, but the problem is it's data specific. And between now and the middle of June next month, if they feel like the data supports another Fed hike, they might do it. But the good news is here, we are very close to the end of the Fed's tightening policy to combat inflation. So this is the Fed's response to inflation. Look where we were back in January 2022. We were at 0% Fed funds rate. I mean, banks could borrow from the Fed and from each other. I mean, basically 0% to 0.25%. It's a 0 to a quarter. It's always a quarter range. Look at this dramatic move up. Anytime you see an escalator that's this dramatic, by the way, this goes back to July 2018 to 2023. So it's a 5-year chart. But you can see how dramatic the move up was. Whenever you have that sort of move up, it's like the Tom Petty song, what goes up must come down. That's not going to be something that's very typical. And so we've had 3 hikes in 2023 by the Fed. We've had 10 since March of 2022, which is why you can see this dramatic escalator here. The good news is this. We're getting close to the inflation being under control. I think it is under control, and I think the Fed should not be increasing in June. I think the Fed has a lot to do with the problems that we are having. It's like giving a patient medicine and not waiting for the medicine to kick in. They've had so many Fed rate hikes, but they haven't let it be digested into the economy yet. So if they do hike in June, it'll be the last time. I think they shouldn't. Hopefully they will not. But here's a real positive sign for the real estate community is the last Fed funds rate hike in a cycle. I mean, the last time they hike rates in a cycle, and this right here is a cycle of moving rates up, okay? What follows that cycle? 2 things have always 100% followed a Fed rate hike cycle pulse. 1, real estate values went up. 2, mortgage rates went down. Both of those things are going to be helpful for buyers and sellers and the overall real estate economy, and as well as transactions. Because I'm in the mortgage business, we want transactions. You guys are in the business of helping buyers and sellers attain real estate. We want transactions. Appraisers want transactions. Escrow title wants transactions. So we need transactions, and this will bring transactions to inventory, which I will get into here in a few minutes. Okay, so I wanted to give you an analogy here because inflation is the arch enemy of bonds, and interest rates are connected to bonds. So interest rates are bonds. And whenever you have inflation, it deteriorates the income that you receive off that bond. So if you're receiving $100 a month of a bond, and that can buy you a certain amount of goods in May of 2023, and in June of 2023, that $500 buys you not the same amount of goods you could buy, then that means that you're being deteriorated on your rate of return. So here is a chart going back to 1973, I believe. And this is a 30-year fixed rate chart, and it shows you where the 30-year fixed rates have been. You can see the dramatic increase we've had since the Fed has started increasing the Fed funds rate. And this down below is an inflation chart for the same exact period. And once again, you've got your shaded areas of recessions. You can see how exactly similar these charts go. Interest rates go up, inflation goes up. Interest rates come down, inflation goes down. Interest rates stay somewhat steady, inflation stays somewhat steady. So inflation is driving interest rates. Interest rates is driving the lack of inventory. So I'm going to get into that, but this is very important. If you take one thing from this presentation, you need to understand that until inflation gets under control, we will not see price stability, and we need price stability to bring back inventory and to bring back buyers for affordability. Prime rate. There's lots of questions out there. Exactly what is prime rate? Well, today prime rate is at 8.25. The Fed increased rates last week by a quarter, so the prime went from 8% to 8.25. The rule of thumb here is that prime rate is 3% higher always in the Fed funds rate. So if I told you the Fed funds rate was 5 to 5.25 today, prime rate should be 8.25, which it is. Now, why is prime rate so important, and why is an increase in prime rate so important? Because you can see you can see the increase in prime rate, you can see the decreases, the increase, and every time we have a dramatic increase in prime rate, by the way, up, recession, up, recession, up. Is a recession following? Yes, I believe so. Up, recession, up, recession, up, recession, up. So prime rate is the cost of money that commercial and businesses lend at. So it'd be like interest rates for a real estate mortgage, but it's the interest rates that are paid for by businesses and commercials, by banks to be able to conduct business, to create services, to create goods, which pumps up the economy. So obviously, the higher the prime rate is, the harder it is for businesses to make money, and the harder it is for them to keep their employees if they're not profitable, because they can't afford to keep their employees. And if they cannot keep employees, then they need to cut production of services and products, and less production of services and products is an inflationary thing. So it's very important that prime rate settles in here. And the only way it could go up again is if the Fed increases the Fed funds rate June 13th to 14th. They'll make their announcement on the 14th. And if they did, say by a quarter, then the prime rate would go up to 8.5%. But it's very important to understand the dynamic of prime rate connected to the Fed funds rate. The Fed funds rate affects a lot of things. It affects indexes, credit cards I'll get into, car loans I'll get into. So all that stuff is affected by prime rate, and it's at 8.25 today. Okay, time for cash out refinances. This is interesting. So I've got two things here. I've got the first slide is a personal savings rate slide, and the second slide here is a credit card balances. And you can see that credit card balances, the personal savings rate increased dramatically. So this is the percent of money that people are saving. And this is over a period of time that goes back to beginning of 2018 to current. And you can see that people are saving a lot of money in this area right here, this shaded area. That was the last recession we had. And that was also the time that the Fed had all these stimulus packages, and they were giving money away to businesses. They were doing the best thing they could to pump money into the system. So a lot of people in early January 2020 to about middle of 2020 had more money in the bank than they maybe have ever had and maybe will ever have. And so they felt very, very comfortable. But look what's happened since the Fed has stopped their stimulus packages and putting money into the economy. Instead, they've been tightening. They've been increasing the Fed funds rate. We saw that, which is increasing prime rate, which is increasing interest rates. Look at the savings rate that has happened to the average American. Has come all the way down, and we're at like just over 5%. We almost peaked out at 35%. So people are saving less money. The second thing is credit card balances. Credit card balances were on the rise. People started getting more money through the stimulus packages, through the Fed giving out easy money. And look at the credit card balances came all the way down here and bottomed out in mid of 2021. Once again, when people all had a lot of money in the bank. Look what's happened since they started their tightening policy with the Fed funds rate, prime rate, interest rates. It's gone up significantly. So credit card balances are on the rise. And these two numbers here, 14 and 20, the average credit card cost was 14%. With the Fed funds rates being moved up, that affects all indexes like prime rate as well as credit cards and car loans. It's up to 20% is the average interest rate that people are paying on their debt. Okay, so there's a lot of people that have a lot of debt and they're paying high interest rates on it. Also, the average car payment over the last 3 years has doubled. It's now $800 is the average car payment. So inflation is a real thing, and the burden of that is a real thing. But here is a silver lining. The average loan to value in the United States going in 2008, coming out of that recession, was 81%, which means people had 19% equity in their home. So if you had a $100,000 home, you had $19,000 of equity. Okay. The good news is 2022, you had that same home that's worth $100,000, which we know would be worth more. But if you did have a $100,000 home in 2022, you would actually have $58,000 of equity, because the LTV is the average loan balance. So they would owe $42,000 on the home, but they would have $58,000 of equity. So the silver lining here is, and why I think this will be a short-lived recession, is because the real estate market is going to pull us out of this recession, because there's a lot of Americans who have equity in their home, and that makes them sleep well at night, even though they've got high credit card balances. They've got a way to access the money and to pay off their debt, and they will be doing that with refinancing. As soon as interest rates come down to a more affordable area, there's a lot of people still refinancing at these levels. You can make an argument, even if your rate was at 3% today and you're going to 6% or 7%, we can do a cash flow analysis and show a lot of people with credit card debt, they're still better off by thousands of dollars a month in cash flow savings by refinancing at these interest rates. So you should definitely reach out to your Franklin Loan Center representation to have that conversation. But this is the silver lining, because the last real estate bubble we had, we didn't have equity in real estate that allowed us to tap into to get out of this recession. So this will be what will lead us out of this next recession. Okay. I always talk about this. For those of you who come to Market Watch consistently, I have this slide in every one of my Market Watch presentations over the last 8 years. I don't skip it because I think it's 100% accurate and it's very easy to understand. And that is the 10-year, 2-year Treasury yield. And it takes the yield or the interest rate on the 10 years. So if you lock your money up for 10 years, what they will pay you compared to what they will pay you if you lock it up for 2 years. In a healthy economy, if you lock your money up for 10 years, you should be paid a larger rate of return than locking it up for 2 years. But there are times when the economy is sick, which it is now, and the actual 2-year yield, the money they'll pay you to lock your money for 2 years, is higher than 10 years. So why would anyone want to lock their money up for 10 years? They're going to pay you less than 2 years. I'd lock it up for 2 years, so I have access to it. And so anytime you see, this is zero. So anytime you go below zero, it's red. Anytime you're above zero, it's positive. So when we're above zero, that means the 10-year money is paying you more than the 2-year money, which is normal. Anytime it's red, it's inverted. We have what's called an inverted yield curve where they're going to pay you more money to lock your money up for 2 years than 10 years. And so you can see we have been inverted in this red area for a long period of time here. And every time we've gone inverted, it only goes back to 1976 for this example, because the 2-year Treasury and 10-year, there wasn't a 2-year Treasury. It was only a 10-year back then. They started in 1976, which is the year I was born. And so you can see that every time we go negative, you have a recession, negative, recession, negative, recession, negative, recession, negative, recession, negative. That was the last one, recession. That was the COVID recession. And here we are again. Okay. Now, I don't want to concern you that or alarm you that recessions are technically bad. Recessions are healthy. And it doesn't always mean your real estate values are going to go down. I'll get into that here. But here's one more topic I want to talk about with recessions, and I'll get off this. And that is unemployment rate in recessions. Once again, you've got these shaded areas here that are recessions, and you've got the unemployment blue line. And you can see unemployment with the COVID period popped up. This is where restaurants are being closed, businesses are being closed, and it's come crashing down. And we're basically 3.4, 3.5%. Okay, the problem with this, the BLS, the way that our employment numbers are done, there's lots of ways to look at it. And I could do a whole presentation just on the many different ways to look at unemployment. But at the end of the day, no one really truly believes unemployment is as low as it is. You can't turn on the TV. You can't get on the internet without seeing big, huge companies and small companies laying off employees. Unemployment is the last thing that goes up in a recession. So it's not a leading indicator. It's the furthest lagging indicator. So it's the last thing that'll move, because that's the last thing people want to do is cut their employees, cut people that are part of their company. And so that'll be the last thing to tick up. And I believe you're going to see this number tick up for the remainder of the year. And that will be the last trigger that has not been triggered for a recession. Okay. Once again, I can go through leading indicators that are all pointing to it. We are definitely going to recession. I personally think we're already in it. There's economic board that actually comes out and calls recessions. They call the recessions after we're out of them, not while we're in them. And so if we are in a recession here in 2023, they probably will not announce that until sometime in 2024. Okay, next, labor market. Just spoke about this. Jobless claims are on the way up, which means more and more Americans are looking for jobs. And that means their jobless claims, and job openings are on the way down. So you don't have to be a scientist to see if more people are looking for work, and there's less openings for jobs, that you're going to see struggles in the employment market. And you can see here, this goes back for 2 years, and you can see the dramatic increase. Once again, anytime you see dramatic increases like this on any chart, there's more to it. And this is the initial jobless claims are way up. And here's job openings. You can see this steep drop off. So there's less opportunities for these people that are looking for work to get work. Basic supply and demand, basic numbers. People are not talking about this. It's real. And the unemployment numbers are on the rise. And there's been some games being played by the BLS, by the way they're reporting these numbers. And when they finally come out and clearly show the numbers with transparency and not arithmetic games, you're going to see that. Okay, so this is something I want to make sure I'm clear on as well. I spoke about, the housing numbers and shelter coming down, meaning they're not appreciating at the same level, but they are still appreciating. And when you own a home, you want your home to appreciate. You don't want it to go negative. This is a case-shiller index. This is the gold standard for real estate values in the country. Everyone looks to this. Every economic person goes to this. And every time you see a shaded area here, once again, that is a recession. And if you look in the 1960s, you enter the recession, real estate values went down a little bit. But look at every other recession we've had, with the exception of the housing bubble in 2006 and 2008. In a recession, real estate values went up. 1970s, mid 70s up, both of the 80s up, 90s up, 2000s up. This is the one we all remember. Real estate values came crashing down in this housing bubble. We are not in a housing bubble. I'm going to talk about this in a minute, but this is the one everyone remembers. So everyone's always fearful. Recession, lower real estate values. That's not the case. I just showed you 2 of the last 9 that went down. 7 of the last 9 went up. Now, there's many people out there who say, well, I can remember these recessions and real estate values didn't go up. The point being is, some markets, you might see real estate values down in the recession, some markets up, but the overall, if you average everything nationally into one, it goes up. And so, yes, I'm sure that someone can poke holes into this, but at the end of the day, this is a national index, and you can see right by the chart, when we come out of these recessions, real estate values are higher. So please do not be alarmed that real estate values are coming crashing down in recessions. Recession is needed. It's well overdue, and real estate values will do fine. I'll talk more about that here. So once again, here's the Case-Shiller Home Index. We just spoke about it with recessions. This is all transactions. So Case-Shiller looks at cash, looks at every transaction that happens, okay? 121 months, 10 years and 1 month, you saw real estate values go up, okay? In about June of last year, real estate values started to come down a little bit. Now, when I say they came down, I'm not saying they dropped off a cliff and came down here like we've seen on some of these charts, okay? This is a very mild rollover, and now it's actually coming back up. So if you go back and you look at the peak of June of 2022, when everyone said almost a year ago, real estate values are going to get hammered, they're down 2.9%. 2.9%. Now keep in mind, if they were up 20% over the last 24 months and they're down 2.9% over the last 10 months, then you're still up 17% over the last 2 years. You're still up. You're not down. You're just not up as much, okay? And so you can't have a straight arrow up to here. We're going to have areas where it levels off, but over time, real estate values always go up. Once again, the 2006 and 2008 real estate crash is what everyone remembers, but that is something that hasn't happened in the last 100 years. So this is very important to understand. We are not in a housing bubble. We are in a small correction, which is slowing the appreciation values. It's not going negative. Now, I'm going to give you another example here. This is FHFA's home price index. This looks at only transactions that have a Fannie Mae, Freddie Mac loan on it, which is about 55 to 60% of every transaction is financed by Fannie Mae and Freddie Mac. And the reason the rest are not is because, 1, they're cash, or 2, there are types of loans like non-QM, which is not offered by Fannie and Freddie, or interest-only loans, bank statement loans, okay, or jumbo loans. Anything goes over the limit that Fannie Mae and Freddie Mac will lend. Well, check this out. Once again, peaked in June, came down a little bit, all the way back up, based on loans that Main Street, blue-collar America gets. Real estate values are down 0.2% from the high of last year. So people that are out there looking for doomsday, people that are waiting for real estate values to come down, you're kidding yourself. They're not coming down. I'm going to give you some more information on the inventory, but these are the 2 gold standards you can look at for home appreciation value. Existing home inventory. Okay, this is one of the reasons why I think real estate values will continue to stay strong. First thing is, this goes back to 1999 to 2023, and we can all remember this housing bubble inventory in 2007. 4 million units were on the market for sale. Okay, today we're at 980,000 in 2023, and of that 980,000, about 35% of those units are actually pending. So it's more closer to like $500,000 to $550,000 of homes that are actually available for sale. And the crazy thing between 2007 and here is the U.S. population has increased by 30 million people. So you have less inventory and you have more people trying and wanting to buy a home. So it's only causing more demand on a low amount of inventory. When will inventory flip? 5.5% on a 30-year fix is what all the studies show. When rates get to 5.5, which I think is going to happen by September 1, I think May, June, July, and August, you're going to see massive improvement in the CPI indexes because inflation coming down, price cost easy. When you get to 5.5%, there are a lot of Americans who want to sell their home but do not want to go from a 3% mortgage to a 7% mortgage or a 6.5% mortgage where we are today. They will though sell their home and go from a 3% to 5.5. That's a stomachable number for them. So when we get to this number, there is help on the way, and this number is coming fast. I expect it to be here by the end of summer, so I'm going to say September 1, so that is good news. Speaking of opportunities, this is something I wanted to share with you. I saw and I thought was a very good analogy for people to look at. Use the current market as an opportunity. So here's a V shape, okay? It's difficult to get the exact bottom, not only in real estate, in the stock market, any sort of commodity or free market. It's really hard to time this bottom, okay? The best time to buy a home is here. And that's before the bottom because sellers are more fearful and there's less competition out there, okay? The worst time to buy a home is after the bottom when you're on the way back up because sellers are more confident and it's much more competitive. Where are we right now in this side of the market? I'll leave you to make your opinion on that. I don't think that we're at the bottom yet. I think we're very close. I think late in 2022, there was great opportunity for buyers because sellers were more fearful. As inflation comes down, interest rates come down, it's most likely going to give sellers more enthusiasm and it's going to give buyers more enthusiasm. So those things will create a hotter market. So this is something I think is interesting to think about. Like they say, it's always best to buy when people are fearful and sell when people are happy. So once again, just something for you all to think about. Okay, I'm going to park here for a minute because there's a lot of questions about this chart. And I call this the heat map, okay? And basically, red means higher LLPAs. LLPAs is low level price adjustments, and these are not new to Fannie Mae and Freddie Mac. This is only regarding Fannie Mae and Freddie Mac, okay? But what Fannie Mae and Freddie Mac does is followed by big banks, but they may not make as large of an adjustment. They may undercut their competition, which is Fannie and Freddie, by having some LLPAs, but they won't make them as large because they want to try to get the business, okay? And the green is lower LLPAs, which means they've changed to be beneficial, okay? So these have been around a long time. So let me bring you down memory lane for a second here. About 2 years ago, Fannie Mae and Freddie Mac came out and they said, we are not interested in helping Americans buy second homes in non-owner occupied properties. And we're not even really interested in giving them cash out because we don't want them to be at danger of losing their home and putting high loan amounts on it. And if there is a real estate correction, then we have a housing bubble again. So they put low LLPAs, low level price adjustments. If you buy a second home, you get a higher interest rate. If you buy an investment property, which I call non-owner occupied, you get a higher interest rate. If you want to pull money out of your home, not a rate and term refinance, just improving your rate. They encourage that. But if you're going to pull money out, especially at the higher bandwidths of loan to value, they want to charge you higher interest rates. So this is not new. It's been around a long time. They actually just cleared this. There was a DTI LLP that was supposed to go in place, which was suspended 60 days ago, was supposed to go in place by, I think it was August 1. That has been eliminated, which is great. So I'm not going to get into that, but that's basically charging people a higher interest rate if their debt to income ratio went over 40%. So that has been resolved, which is great. Okay. Sandra Thompson. So to go over this map, Sandra Thompson, who is the head of the board for the FHFA, she wants affordable housing. She wants to get Americans into homes. I think we could all agree that we want every American to have an opportunity to buy a home. So what she's done here, though, is she's gone against everything Fannie and Freddie's ever done when it comes to their loan level price adjustments. They're all based on risk-based premiums. So the riskier a loan is, the higher interest rate should be, because they're risking the American taxpayers' fund on someone whose credit worthiness isn't as good on credit scores and are putting less money down. What Sandra Thompson's done, it went in place May 1, and it's actually been in place for any loan that closed really after April 1st, because those loans have then got to be sold to Fannie and Freddie, put into large bonds and sold out to investors. So really, this has been in place now for about 45 days. She wanted to encourage people to buy homes that don't have as much money to put down and have lower credit scores. So I'm going to give you an example here. So if you look at someone who has a credit score below 640 and 659, goes down from 639 to 620. You cannot have a score below 620 and get a Fannie Mae Freddie Mac loan. You can on FHA, but not on Fannie Freddie Mac. And you can see as of May 1, if someone was to put down 3% only and has a 620 score, which is the lowest score you can have to get a loan with Fannie and Freddie, she improved the pricing for that borrower by 1 3/4 on the LLPA. Every 3/8 in LLPA creates an 8 in rate. So you got 3/8, 5/8. So you basically got 5/8% that a borrower is going to get a better rate. So if they were supposed to get 7%, they're going to get 6.375% because they're trying to encourage people with lower FICO scores and less money down to buy homes. Okay. Anytime you see red, so green is good. Anytime you see red, that means the pricing has gotten worse. So for someone who has a 740 FICO score, puts down 20%, okay, actually 19.99%, they're going to get 3/4 in LLPA adjustments worse, which means they're going to get a quarter worse in rate on May 1 than they would have got before May 1. Where these individuals down here are going to get 5/8 better. So you take 5/8 plus a quarter, you got 3/4%. So this borrower here with the worst credit score and the least amount of money down is going to get a 3/4% better rate than an individual with a 740 FICO, which is very good, pays all the payments on time, been responsible, and save money, put down 20%. So they are subsidizing borrowers that put down more money and have better credit to subsidize and get better rates to individuals who have less money down and higher FICOs. Everyone's got opinions here. I know that. I'm not outlining opinions. I'm only outlining the facts. This is what's happening. Sandra Thompson is trying to bring affordable housing to low FICO and low savers. Where does this go from here? A lot of things can change constantly, but that's where we are today. If you want to reach out to your Franklin Loan Center representation to discuss this further, please do. This is a very hot topic. But I wanted to touch on one other thing while I'm on here, and that's the STRs that Kenny Cassady talked about regarding short-term rentals in the mortgage industry. 95% of all products does not look at short-term rental income when you're qualifying to buy a property. They look at long-term rentals. So the appraiser will do a rental survey over a year period, and they'll show you where you can rent it long-term. That's typically what a bank will use to help you to qualify for an investment property, what that income number is. So I just wanted to make sure you all know, because ultimately someone pays cash for a property, they can do whatever they want and they can rent the house wherever they want. But when you get a partner involved, which is a mortgage and a bank, there are certain rules on the income piece. And so I wanted you all to know there are some products out there. I'm talking out of both sides of my mouth, but it's not Fannie Mae, it's not Freddie Mac, it's not Main Street Money. It's what's called non-QM, almost subprime, higher rates that could use ERBO income to qualify. And I did feel like I should touch on buy downs real quick, because I know Mike McDonald spoke on that. Buy downs is a great topic to talk about, and it's being used widely in the new home market by builders, buying down temporary rates or permanent rates. It's not as popular in the resale market because someone has to buy down that rate. Someone's got to pay that fee, that cost. Sellers right now do not feel like they want to pay $20,000 in fees to buy down a rate for a buyer, because they feel like they're pricing their home competitively at the market, and they want to maximize what they can get. So the buy downs is helpful in new home, and we are doing them in the resale market, but we're not doing them nearly as much as people are talking about. It's one of those things that a lot of people talk about, but it's used 1 or 2% of the time. Maybe 2% is even high, maybe 1. I'll give 2%. Maybe we use it 2% of the time. So it's out there. It's a tool we use to help transactions get put together, but it's not a tool that people are aggressively using in the resale market, because if you were a seller, you would like to maximize what you sell your home for, and you would like to minimize the concession that you give to the buyer. So I know that was a lot of information. One real quick up here reminder, this is the This is the FICO. This is the LTV, how much money people are putting down. So this is 3% down, 5% down. This is 10% down, 15% down, 20% down, and this is the credit scores. So if you have questions on that, please reach out to your Franklin Loan Center organization. We can talk more about it. Okay, and in closing, the last topic before I give you a summary is the banking system. A lot of people are concerned about the overall health of our banking system. So I want to explain how the banking system works, okay? So first of all, you go to a bank, you put a deposit of $100,000. That bank, based on today's laws, are required to hold 10% of that in liquid reserves where it's available to be taken out of the bank tomorrow. So if you put a $100,000 deposit in, the bank has to keep $10,000 liquid, and the bank then takes the $90,000 that you gave them, and they try to make money with it because their banks are for profit. And so let's say that the $100,000 you put in the bank, they're going to pay you 0.5%. They're going to pay you $500 a year in interest. Okay, that's a liability for the banks. They got to pay that for you for the money. So the cost of their money is 0.5%. They're going to then go out and lend it at 2%. So if they lend it out 2% on the $90,000, they make $1,800 a year in interest. So what they've net $1,300. So that's how banks make money. They take your money, they pay you less for it, they lend it out, and they make more money. And that's how the banking system works. Well, the problem is if the banking system has a run on its reserves, which they only have 10%, and people start being concerned that their money's at risk, well, that's when banks can go under, even if they've got great performing assets. It's a self-fulfilling prophecy. And we've seen a lot of that. So the banking crisis, you guys all know about SVB. You guys all know about Signature Bank. You all know about Credit Suisse, and you all know most recently about First Republic Bank. What happened to these banks? Well, these banks were all fundamentally run well. There'll be some people argue that with me, but they had performing assets. Their banks did not go under because they did bad loans. They went under because people rushed to these banks to take their money out. And if more than 10% is asked to be taken out, it puts a bank in a very bad position to survive. And why would people want to take their money out? Well, there's an FDIC insurance fund, which insures up to $250,000 of any deposit you have with any bank. And that's to keep our system stabilized, the banking system. The problem is all of these banks up here, they had large uninsured depositor relationships, which means that, for instance, SVB was like 88% of their deposits were uninsured. 88% of their customers, which means 88% of the deposits their customers gave them. If the bank went under, they would have lost it. So a lot of those people went rushing to SVB to pull their money out because they were concerned that if the bank went under, they would lose their money because they're only insured up to $250,000. So if you've got money in the bank and you've got an account with less than $250,000, your money is safe. But if you've got money, let's say $1 million in an account, technically speaking, you have $750,000 at risk. Okay. So that's the uninsured deposit relationship and the struggle these banks are having. The other thing the banks are having is the market opportunity and the customer fear. So a year ago, and we talked about this has all been created by the Fed. We talked about that escalating the Fed funds rate. And every time they move that up, cost of money goes up. Problem is, we've been in a stimulus package. We've been in an easy money era for a long period of time. And all of these banks had all this money coming in, all of these deposits. And they were investing those deposits in treasury. They're investing them in mortgages. They're putting them into low yielding investments, 2 or 3%, because that's all there was in the marketplace. And so what happened is, and this is also free market. A lot of people started putting out negativity that, like, for instance, SVB, that these investments they had were all underwater. And that if they had to sell the investments, they would lose billions and billions of dollars. And then people are saying, wow, okay, well, now this bank's not going to be profitable. If they're not profitable, I don't want to have my money there. So all these investments that they've invested in over the last couple of years when rates were low, now all of a sudden that rates are high, there's market opportunity for people to take their money out and go put it elsewhere. So let me give you a real estate analogy so you understand the investments underwater. Imagine in 2008, because this happened, and I know many people this happened to. They had a home that was worth $1 million, okay, and they owed $800,000. 2 years later, they still owed about $775,000, let's say, but the home was worth $500,000. A lot of those people short sold, a lot of those people foreclosed because they owed down $250,000. Okay. Imagine if a bank called you up and said, Mr. and Mrs. Smith, you owe us $750,000 and your house only worth $500,000. We're calling your loan due because we need the money because the investment is underwater and we need to get the money back so it doesn't show as a negative on our books because we have to mark down the value of that investment. Well, they can't do that. So the banks can't go in and call all these mortgage loans they did or these bonds that they put their money in because it's fixed. So they can't go get money to be able to meet the demand that people are asking for the money out. So the fix, short-term fix, and the Fed has done this, and this is why I think that the banking system failures, this whole crisis is coming to an end, is one, they came out with what's called the Bank Term Funding Program, BTFP. That allowed all banks to go to the Fed and take those underwater investments, like the real estate analogy I gave you, take those underwater investments and collateralize it to the Fed at par of what it was worth when they made it and pull out money. And they can then use that money to give depositors their money back when they asked for it, which would allow them to sustain a run on cash requests from the bank. Now, can it sustain a 50% run? Probably not. Can it sustain a 20%? Probably so. So it helps to go from that 10 to 20%, which allows them to get money. Now, the negative is when they borrow the money from the Fed, they're borrowing it at the Fed funds rate today, which we all know, I just told you, is 5 to 5.25. So it's expensive money, and they're not used to having expensive money. So the good news is that's in place. So I believe that the banks will do less lending for sure. So this whole banking crisis is going to hurt the commercial and retail business sectors because a lot of these community banks who support small businesses and middle-sized businesses and large businesses, they're not going to lend right now because they want to hoard their cash because they don't know how many people are going to be asking for the money back. But the beautiful thing here is, and why I think this banking crisis is going to come to an end, as soon as the Fed stops hiking rates, it instantly takes the pressure off the balance sheets of all these banks, takes the pressure off borrowers having a fearful outlook that they need to get their money out because the FDIC uninsured deposits are bigger. And so when they stop increasing the Fed funds rate, the Fed has been, I believe they have been irresponsible in what they've done and how fast they've done it. I understand they're trying to control inflation, but it's a lagging situation, which we discussed, and they need to give it time. And time heals all wounds. Time heals inflation as well. And so the banking crisis is close to being over. I think people are getting used and understanding how the system works. And there are ways to leave large uninsured deposits in your bank and have them still insured. So you talk to your banker about that, and they can tell you how to do that. Okay. And in summary, in closing here, one, inflation will continue to ease. I spoke about that. I showed you the lagging index, how it works for not only shelter, but the CPI in general. Remember that roller coaster? So that's going to come down. As inflation comes down, as we discussed, interest rates will follow inflation lower. I believe you're going to see them 5.5% to 5% this year. I believe a recession is imminent. I actually think we currently are already in a recession, and I think they will call that next year. I do think it's short cycle, short-lived, which is a blessing because of the amount of money that the real estate market has been able to muster up and gain over the last 10 years. And I think it's going to go sideways to up from here, not sideways. I think it's going to go up from here. So that is the positive side. Real estate will continue to appreciate a low inventory. We have a growing population. We talked about that. We've got higher rates, so people are less likely to move. Demand way outweighs supply. New home builders cannot keep up with this. So I think you're going to see real estate will continue to rise. A low inventory. I do think inventory will pop up a little bit when rates get to the mid fives. Expect buyer and seller activity to increase. Lower rates. I spoke about that. Lower rates will bring inventory and people will sell. And last, banking crisis to fizzle out as Fed stops their historic monetary tightening policy. The Fed has caused this reaction, has caused the struggle in the banks, has caused the interest rates to go up, has caused the stress on businesses. It is the new COVID. The good news is we are seeing signs of recovery in inflation. So I feel like the worst is definitely behind us. And I do believe the best is yet to come. So I hope you all enjoyed this presentation, and hopefully you all can get to the next Market Watch in person. If you're watching this one, then you are watching our virtual presentation. Franklin Loan Center is very honored and blessed to be considered the Coachella Valley's lender. Like I said, 34 years in business. We take that responsibility very serious and do our best to give back, especially on these educational events. So we appreciate Palm Springs Life, Mike McDonald, Kenny Cassady for partnering with us to share this information with you. So on those notes, I wish you all a joyful and happy rest of the year. Talk to you soon. Bye-bye.
Thank you for joining us today. And thank you to Michael McDonald, Walter Neal, Kenny Cassady, and to our sponsors. We look forward to seeing you in November for our fall Market Watch.